Hello everyone, welcome to the second video that we're going to be looking at here. Just got back from having a couple beers with some of the neighborhood dads, a couple double IPAs, so feeling pretty confident and hopefully going to be more articulate than Joe Biden at a press conference. Going to try my best here to focus and not fall asleep at the wheel, which would be unfortunate. Heard a funny story today. One of the dads at the beers saying that a couple of weeks back he went on a boys' trip and they went to the they went to go watch a game and had a couple pints and ended up finding themselves at the local gentleman's club and there were three of them together and the one guy got distracted and went to one of the private booths. He was pretty full to the tank tops. He was out over his skis and told the guys he'd be back shortly. Anyways, an hour later, they looking for their mate, and he comes wandering down from VIP, and he's completely stressed out because he took a seat on the couch and fell asleep. And like an hour later, he wakes up, um, gets his stuff, cruises out there, and they've charged him 15 grand on his credit card. And and he didn't know what to do. Um, and he asked for advice and so forth, but I mean, they could see on the cameras they logged him entering and logged him exiting, and tough luck for missing the show and being 15 grand underwater. So that's my lesson for the day: is not to fall asleep at the wheel and not to do dumb stuff and get into trouble. Definitely uh, not planning to miss any shows in the market environment yet. But enough of the soppy stories of sports dads. Let's get cracking into Nat Gas. I chose Nat Gas because we looked at the production profiles of um, US crude oil for the balance of the 2020 year, and that is so closely related to Nat Gas and associated gas production. I thought we'd bridge over to Nat Gas and see if there's a couple of good opportunities for us in that market. So let's dive right in there. Just once again, quickly going through the format of the video. First section is currently what's happening in the market, what the main themes are, what's driving markets. Part two is what the outlook of view is, and part three is kind of what I'm looking at: trade ideas, structures, etc. So, what's shaking in the nat gas world? Um, Latest EIA number that came out Thursday for the weekend in on the 24th of April was the 70 BCF build. This was very much in line with market consensus and what the broad market was expecting. Um, what we're going to be looking at in this video is a lot of supply and demand and how we can position ourselves there in a risk reward trade. Associated gas production declines versus the demand declines. So it's basically a tug of war, yeah, between what guys see for production declines versus the demand declines um, going into the month of May. part two, what I'm seeing in the market. Associated gas production declines has been the talk of the town over the last month. We've seen it in the price action. I'm showing the July Henry Hub contract here. We saw it come off the lows and rally to where we are now because of the production declines that we're going to be seeing over the next couple of months. This is also kind of an area that guys are going back and forth on, and where there's quite a few differences in guys' models is how they're modeling the declines over the next quarter. So I just wanted to touch back on something I chatted about yesterday in the video, the crude oil production profile. This is so tightly linked in the US to the associated gas production. I just wanted to have a quick look at this again and back into a few numbers. So crude oil production declines, I've modeled them as a 1 million barrel a day decline in May, 400,000 in June, and then another 200,000 a day in July. Back of the napkin mathematics and looking at historical correlations, this should translate in to roughly 2.7 BCF a day decline in May, 1 BCF a day decline in June, and half a BCF a day decline in July. The total associated gas decline over the next 3 months should be slightly over 4 BCF if my crude oil production profile for the next 3 months is accurate. On the demand side, baseload demand in the industrial sector likely won't return to levels we saw before COVID-19. We're seeing big industries suffer losses on a baseload level, which is going to impact demand going forward on a structural basis. Global LNG market is heavy at the moment. TTF is pricing below variable cost of LNG, and hearing numerous cancellations or failures of cargoes that have been booked over the last while. Residential as well as commercial demand is seasonally much weaker in the summer. To give you an idea, often in the winter months, your residential and commercial demand in BCF terms can be between 40 to 50 a day, and in the summer you see that drop to as low as 8 to 10 a day. So as we exiting winter and into spring and then into the warmer months in North America, we're seeing the demand from a residential and commercial standpoint drop off fairly considerably. And from a supply and demand basis, your month on month, April to May change is a rather large one, and we'd be expecting about 8 to 9 BCF a day just from the residential and commercial sector in demand losses. Supply versus demand, who will win over the next couple of months? If we look at the storage, that's modeled in the lower 48 of the US for Nat Gas and BCF. The historical data through the beginning of the year is from EIA, and then I've modeled out the expectation going into the summer months. As we can see, pretty chunky builds that will be experienced from May forward. So although the market is seeing the declines in production through the associated gas and the relationship to the oil production and the declines that are coming with that, I think they are pricing that in whilst forgetting about the demand destruction that not only happens seasonally every summer, but will be intensified due to COVID, in the industrial sense of things, due to baseline declines on a structural basis. So we have the residential and commercial declines in demand as we go into summer, as well as the industrial baseline declines, which more than offset the production declines that we modeled earlier on in the presentation. So, looking at this, I feel like, I mean, around the 220 mark for July contract natty, it's on the high side. And as we go into May, I expect builds to increase at a faster pace. So the last EIA number was a build of 70 BCF, so 10 BCF a day. I expect this number to increase fairly considerably for the next report, that is for the week ending 1st of May, and for that to continue and to grow into the month of May as those reports come out. So I'm thinking we're going to see builds double in May than what we saw in April, and then it taper off into June and July. But I think as the news has come out from the shut-ins and the bankruptcy filings and capex adjustments on the production side, NYMEX gas has received a pop, and it's just got a little bit ahead of itself. And over the next 30 days, as the data for EIA stats and the builds come through for the month of May, which I'm expecting to be close to double the figure of April, I think we're going to see a correction in flat price or structure, and I'm going to be looking at a way to play that. Section 3, what I'm looking at in terms of trade ideas and where to capture some value. Term structure chart of the future months as well as the at the money bull for Nat Gas. What I'm going to be looking at specifically here, based on the thesis of chunky builds through the month of May, is the July contract over here. It's trading around the 215, 216 range. I'm going to be looking at putting on a trade that has a bit of downside exposure to capture a roll down over the next 30-day period. So there's 55 days to expiry on the July contract, and as I hold it for 30 days, that allows the fundamentals to play out for the bigger than expected builds that I'm modeling to play out, and this contract that I feel has maybe got a little bit ahead of itself to roll down to the $2, slightly under $2 level that the June contract is currently at. We might see this whole curve shift up if the current kind of trend that we saw in April continues, where price continues to rally a bit to the upside because of shut-ins, bankruptcies, etc., that we already spoke about. I expect, if that happens, for that roll down still to happen. So if we rally a couple ticks over the next 30 days as the thesis plays out, should see the roll down, and the July contract converge closer to where June will be exiting. Seasonality of the price spikes and vol and Nat Gas. So 30-day at the money vol. This is constant maturity contract. I just wanted to show you kind of the correlation that of the underlying future with volatility in the nat gas contract, as well as the seasonality thereof. So, as you can see, the big price spikes happen in winter. So, towards the end of the year or in the beginning of the year, those massive spikes are um, polar vortexes or talks of polar vortexes, and you see those massive rips. Um, and those are followed by volatility. It's a commodity skew. It's a negative skew, but you do see vol increase um, when there's massive upside in price. The same as what you'd see in crude oil if there's a massive rally. Need some geopolitical event, vol spike as well. But if you look at the vol smile, um, if there's a small increase of price, then the vol path is that volatility should decrease on at money level. But two things I wanted to point out was the price spikes in the winter months, along with the volatility spikes, and then in the summer months you can see vol is a lot lower. So you see the volatility is a lot more subdued during those summer months um, in the nat gas contracts. But the current, if we look at the current contract, um, you'll see that vol is pretty high, although price is fairly low compared to kind of previous years, etc. July contract, the IV and the HV. You can see that IV has trended higher through April along with the flat price. So we've seen the rally throughout the April month, and IV has kind of gone along with that, and kind of historical vol has kind of flatlined from the beginning of April through to where we are now. Not really reading too much into the IV minus HV, just kind of wanted to point out the flat price correlation with the IV increasing, and why I'm not too worried about having negative Vega dollars um, in the trade that I'm looking at. So kind of what I'm looking at here is a zigzag where I've oversold the out of the money put. What the structure is giving me is 55 days to expiry, so it's giving me 30 days through um, May, for the fundamentals, the thesis that I explained to play out. And if the thesis doesn't play out and the market rallies, well, then this structure has cost me nothing, and I might even pick up a couple of theta dollars if things hang around, current price levels, and if there's bull kind of sells off a bit here. So, kind of from a risk reward perspective, this is something I'll be looking to hold for I'd say 35 to maybe 40 days, but kind of looking along that kind of red dotted line, which is in 40 days time. Those will kind of be the exit levels. If something wild happens, and everyone looks at the video and everyone starts getting aggressively short, and the futures price sells off aggressively, you can always exit it. The big risk is a gap down, but I think the bigger risk is a gap up in a natty market. So I'll sleep okay tonight, or should I say tomorrow night after I've put the position on. But this is what I'm looking at. Any thoughts or feedback is welcome.